America First ETF. Okay. So they invest in companies with politically supportive of Republican candidates.
Yeah.
So they might have, I don't know, could be like a donation to Trump or to the party. Interesting.
It is.
So the must have been rising.
It is. Yeah, it has been. I'm sure you'll go further today.
Yeah. Yeah, gone up slightly so far this month. Okay. All right. Yeah. Now the Trump implied probability of winning is still not very high, but high enough. 67%.
Yeah. Looks like a done deal, man.
Yeah, sorry. Got cut off for a while just now. The bond yield also increased after the attempted assassinations.
Yeah. Ladies and gentlemen, we will begin in 3 minutes. Thank you for your patience. Good afternoon, ladies and gentlemen. My name is Sing Yao, and I'm standing in for Dylan today as he's on summer block leave. What a week it has been for capital markets, to say the least.
Recording in progress.
All three US major indices closed up on Friday in a week that was helped by cooling inflation trends and the Federal Reserve actually laying the groundwork for rate cuts. Techs were also an incredibly exciting area to watch as Nvidia fell by over 5% on Thursday, possibly on AI fatigue, but also possibly of markets' anticipation that flows or capital market flows will eventually rotate into cyclicals. As a case in point, the Dow rose more than 200 points on Friday, touching new record highs above 40,000. This was the first time the 30-stock blue chip index rose above 40,000 since topping that milestone in late May. The Russell 2000 index also jumped 6% for the week after gains on Friday, as investors probably saw that a so-called likely soft landing for the broader economy would give a boost to smaller companies. What was notable was the fact that markets rallied even despite meager reactions to banks' second quarter earnings. So Singapore stocks, as an example, the trading value also hit record levels since end May. Key gainers were interest rate sensitive REITs. So you can betcha that among the panelists we have on today, we will be speaking to our S-REIT specialist, Krishna Guha, later in the show. And last but not least, capping off the week, there was an assassination attempt on Donald Trump over the weekend. So what implications will this hold for markets? Our conversations today with the panelists will be structured along the following three key themes. One, is a bigger bond rally coming? Two, what are the election scenarios? And three, if markets are rotating out of tech because of valuation concerns and possibly into cyclicals, what should investors do with a stock like Singapore Airlines? Right. So let me first invite my first speaker onto the show. He's our fixed income head, Winston Poon. So my first question to Winston is basically this. Winston, there's been a lot of coverage on the CPI numbers last week. Is the last US CPI print overstated in your view due to seasonal factors? And if not, will anything else stall the momentum towards a 2% environment?
Hi, Sing Yao. Good afternoon, everyone. I think the tide is turning for US inflation. Because if we recall the first few months of the year, up until April, US inflation surprised mostly to the upside, to the extent that the Fed actually were forced to walk back their dovish pivot in January. And last month, the June FOMC, they actually had to revise their dot plot from 3 cuts to only 1 cut this year. But if we look back the past 2 months, the inflation data was already good in May. Last week, CPI data turned out to be even better than expected. If you look at the numbers, headline actually fell minus 0.1 month on month. And this is actually the first negative print for quite some years. Core CPI is actually also came in below consensus. Although I have to say the headline number was actually driven by some probably one-off factors. For example, the gasoline prices had quite a big decline in June. But if you look at the core numbers, core goods inflation has been very benign. And for the past 2 months, actually on a month-on-month basis, falling marginally. Quite importantly, core services inflation slowed to only 0.1% month-on-month in June. We have not seen such a good number for quite some time. For comparison, earlier this year, the average was 0.3%, and last year average was 0.25. So the core services for June, 0.1, it was a very, very good number. I think there should still be legs for the disinflation trend to continue. Why? Because we expect shelter disinflation to actually carry on for the rest of the 2024. Because if you look at the market rents, for example, it has actually corrected quite meaningfully.
Okay, thanks for that. So if I hear you correctly, that you and I also both think that the bond rally in UST is sustainable. And, the context here is also we started 2024 with markets thinking that there'll be 3 rate cuts, 2 rate cuts, 1 rate cut to 0. So are we back to that 3 rate cuts scenario for 2024 or somewhere in between?
Market pricing has gradually shifted back to a 2.5 cut currently from closer to 1 or 1.5, just about 1.5 months ago. Bond yield, I would say, compared to a few months ago, is not as compelling because back then the market pricing was very, very hawkish. I think I still remember when I came to the show, market pricing was super hawkish, even to the extent that some were not expecting any rate cut at all for 2024. But I think since then, market pricing has repriced meaningfully. But I don't think the market pricing is too dovish or unreasonable. For example, between now and end of 2025, end of next year, the market pricing is only for slightly more than 6 cuts. So that actually means the pace of cut for the Fed market expectation is only about 25 bit per quarter, which I think is actually quite a reasonable expectation. But of course, it's going to be data dependent. We had 1 or 2 months of good data. Market has virtually priced in for a cut in September now. But not forgetting there are still 2 data points between now and September FOMC. There will be 2 more non-farm payroll number. There will be 2 more CPI numbers.
Okay. All right. Then if I may just end up with one more question for you is, we've talked about US Treasuries. What's your view on the Singapore and Malaysia government bonds then?
Singapore government bond yield has been tracking the US Treasuries on almost 80 to 90% beta. And I think this will continue because Singapore doesn't have its own policy rate. And for end of the year, because our expectation is for the 10-year Treasury yield to fall below 4%. So Singapore 10-year SGS yield, I think it will also fall below 3%. Malaysia, on the other hand, the ringgit bond has been trading on a very resilient domestic profile. What I mean by that is, if you look at the beta, it's only about 20 to 30%. It's not as extreme as China because of the PBOC is having a monetary policy that is going exactly the opposite as the Fed. So that's why they are trading on negative beta. But Malaysia has been trading on low beta, 20 to 30% for the 10-year MGS yield. So if Treasury yield decline, I do believe that MGS can also stage a small rally, not big one, but a small one, maybe about 10 to 15 bips into the year end, because domestic demand has been quite strong from pension funds, insurance, and even asset managers alike.
Okay, great. Thanks so much for spending time with us this morning. Thank you.
Thank you.
Okay, now I'd like to basically turn the focus to the US elections. Now, as we all know, following the last US presidential debate, a Trump victory in November is becoming a very, very high probability. Then over this weekend, the assassination attempt of Donald Trump on Saturday has also probably further galvanized the MAGA world around Trump and further reduced Democrats' chances on winning in the 7 key swing states. Now, when we look at the market's performance in 2016, actually in 3 periods, 2012, 2016, and 2020, the Asia ex-Japan indices post-US elections had generally performed very well. Right? So the question now is basically, as we head into November, whether markets are likely going to continue behaving this way. And we all know that, many of the US indices have actually had a very good run. So question is whether the momentum is sustainable, and if Trump does actually clinch the presidential election, what implications would that have on the broader market? We tried to basically catch our chief economist, Hak Bin, for view on this. But because of his business travel schedule, we are now in the midst of producing a pre-recorded interview with him on what his thoughts are on the macro implications from a Trump win. This segment of the interview will be made available in the YouTube video later. So when the final video is prepped, we'll basically send this out through your sales representative. So please have a look at this later. But we were fortunate enough to catch Dylan for a similar taped interview before he went on his summer block leave. And we'd like you to basically take a look at his responses on the stock market. So the first question that we basically asked Dylan was that, from an equity market standpoint, how do you think Singapore is positioned following a Trump win? If I can have my team basically share the video. You're on mute. Scroll back.
But I think Singapore has a few things that's going for it. I think, as Hak Bin said, Singapore is not going to be spared in terms of collateral damage. I think that's a given. But I think Singapore has a few things that's going for it. First is it has a free trade agreement with the US, so that's a key differentiating factor. Plus, it also has a fairly big bilateral trade deficit with the US as well. Plus, it has a fairly diversified import base. So I think when you actually put those factors together, Singapore is probably, on a relative scale, at a better shape than some of the other regional countries.
All right. Then the second question that we asked Dylan was, what are his key sector picks, especially from a winner standpoint as well as from a loser standpoint? Let's listen to what Dylan has to say.
So let's start with the losers first. I think the REITs are probably one of the key losers, particularly the ones with China exposure and also regional exposure. I think with a US dollar primacy, you might have a lot more volatility in regional currencies. So that's going to have an impact on some of those REIT performances. At the same time, interest rates could actually remain higher for longer, particularly if the US continues to go on a deficit spending spree, as well as inflation from the tariffs increase. And that's going to lower the spreads or tighten the spreads between the REITs and the risk-free rate. So that's something to watch out for. The other sector would be manufacturing. I think the fortunes will be mixed. Manufacturers with fairly large Chinese footprints might get caught up with the higher Chinese tariffs, so that's something to watch out for. But manufacturers which are more ASEAN based, and particularly based in Singapore or Malaysia, might actually be in a much more better shape given tariff arbitrage. Now, when we go to the winners, I think the banks are going to be one of the biggest winners. For one thing, as Hagbin said, supply chains will continue to still move to Southeast Asia given the tariff arbitrage, and the Singapore banks have been investing quite a lot of money in integrated business solutions for a lot of these businesses. So I think they will actually benefit from that. Second, they have very large liquid US dollar funding bases, and they have businesses and they have exposure in the US market as well. So these banks will be able to support some of the onshoring measures of companies in Southeast Asia going to the US as well. Plus, if interest rates remain high, NIMs will be supported. And if you continue to see Chinese tariffs and so on, you may actually see more safe haven flows coming to Southeast Asia. So the bank's wealth management side should do quite well as well. One of the other biggest winners will be the industrials, particularly from the US onshoring trend, plus a stronger US dollar as well. Plus, if the US actually does fiscal stimulus to support manufacturing, names like ST Engineering, where 40% of their business is in the US, will be a key winner there. Another interesting area will be the internet sector, particularly for companies like Sea, which are much more centered around ASEAN, versus the more China-centered cross-border platforms like Shein and Temu, who may have some of their businesses curtailed in the US, and they may not have the same level of cash flow and appetite to compete in Southeast Asia, which is a smaller market for them. So I think C might be at an advantage there as well. So that's something to watch out for as well.
Okay, and then finally, we asked Thilan on the most important question here. Basically, what are his top picks for Singapore? Let's go to the video again.
So we have 5 top picks for a Trump win. We are calling them the Trump 2.0 picks. And there, it's very much focused on companies that have more onshoring capabilities in the US. So CSC, along with ST Engineering. We also like the 2 banks, OCBC and UOB, given their ASEAN footprint as well as their US footprint. And then finally, C, given the competitive advantage that they might have in Southeast Asia.
All right, there we have it. Okay, now I'm going to basically take a question from the floor. It's from Mr. John Tan, and he basically asked the question, when we talk about rotations, right, is now the right time to get into REITs? So our next speaker here is very qualified to speak on this topic. He's our REITs analyst, Krishna. So Krishna, hi, and welcome to the show. I'd like to first start off with a broad question in terms of, can you help us put into context how the REIT sector has done over the last week or 2 weeks or so? Because, it's been ups and downs since the start of the year. And, has there been actually any reaction or major reaction to the way that the interest rate markets have moved? Krishna?
I will just say it once again. So we have seen the fortune of the REIT sector turn over the last week or so, and quite fast. So a lot of people who really want to get exposure into the sector. So the REIT sector has been up about 7% in 1 week. And one of the comments I received was that some of the large cap names are behaving like small caps. So very exciting times. In 1 week we are saying that stronger dollar, fiscal deficit, higher yield, and then we have a softer print on the inflation, and we are talking about the sustained momentum on that, and then yield going lower. So exciting times.
Okay, fantastic. So let's deep dive a little on your top picks. So in your recent note, you had focused your calls on 3 of the S-REITs, CICT, FCT, and CLAR. So perhaps if we could just maybe start with Fraser Centrepoint Trust first. And what do you see for this REIT? Is this all about rental reversions, or is there something more that we need to be mindful of?
Right. So again, it is a name that I have mentioned often on this call. So FCT probably needs no introduction to the viewers of this call. It is the malls that you probably walk in and out every time you come to the office or you go back to home. All Singapore exposure, and they are basically in the suburban locations of Singapore. So if you have a domestic consumption that remains stable, if you have unemployment rates that's low, if you have wage growth increasing, then all that goes into the fortune of this particular REIT. So what are things that we need to worry about? We have already seen that e-commerce penetration is there and it is going to be there. So we need to have less of retail mall per capita, and FCT is trying to reposition its portfolio towards the prime suburban malls so that it is able to fine-tune its portfolio to that particular theme. So I think it is a stable name. The key risk for that will be any dip in the domestic consumption.
Right. Okay. So on that point about FCT and the likes of FCT moving into the prime and premium commercial space, is that also the same theme that you are arguing for CapitaLand Integrated Commercial Trust or CICT?
CapitaLand CICT is slightly more different. There you have a diversification. It is also predominantly Singapore sourced revenue. About 90% of the income comes from Singapore, but you do get a diversification there in terms of its exposure to offices, to the retail malls. It is not just suburban, but also on the downtown malls as well. And you do have a component of hotels and the convention business. So it is a bit more of a diversified one. And it also has a better credit rating than FCT. So the investment thesis there is slightly more broader than FCT.
Okay. All right. And lastly, CLAR, could you give us some insights on CapitaLand Ascendas REIT, please?
Yeah. So we have been weaving in and out of this name. If you see our recommendations through the last 1 year or so, and again, the concern has been on the business park, and this is not something that is new. It has been there since we took the coverage of this name back in early 2023. So now we are coming to a stage where it is now the street is kind of waking up to it, and the supply pressure is kind of receding. So and to the point that CLAR also has a A-rated credit and has a diversified revenue profile among its tenants. So it is again one of the more stable names within the REIT sector. And fresh, off the press, we have just upgraded CLAR to a buy in our recent note, which we just published probably 10 minutes ago. We have also upgraded Mapletree Logistics to a buy from a hold. We think the China issue is there and will be there, but our call is a lot more tactical. It is based on the view that if the inflation numbers keep coming down, then the Japanese yen can actually take a turn, which will benefit MLT. So do have a look at the note. It is titled "Make Hay While the Sun Shines."
Make hay while the sun shines. Okay, thank you for that. But before I let you go, Krishna, if I can just wrap this session with just one last question, is that if we talk about CICT, FCT, and CLAR, what's the average DPU or the dividend per unit yield at this moment? And historically,
quite low.
It's quite low at the moment.
Yeah.
Okay.
So if you are a high yield investor, you should not be looking at them. There are names which are giving you 25%, maybe 50% yield as well. If you want slightly less, there is quite a bit spread there. You can get 10%, 12%, 8%, 9%. So there is quite a bit of spread among the 43 names that the REIT sector provide here.
Okay, great. Thanks very much for that, Krishna. Okay, I'm going to bring on Eric, who is our aviation analyst for the last topic here. So earlier on, I had explained that effectively, it does seem like the market, especially in the US, seem to be moving out of high valuation tech space into perhaps more cyclicals. For example, some of these stocks that we have just talked about. So the question then beckons, if we look at a stock like Singapore Airlines, which had the benefit of the COVID run, it's been very nice, a trend for a while. The question is basically, should investors continue holding on to Singapore Airlines, add more, or basically take profit? So I'd like to basically invite Eric onto the show to address some of these questions. Eric, your report is a whole call. Can you walk us through, whether you think now is the best time to, I guess, take some profit off the table? Or do you think that there's still a bit more catalyst to come and that investors ought to basically be patient for a little bit longer? Eric?
Hi, Singa. Thanks for having me. Yeah, as you rightly pointed out, we just initiate SIA with a hold and 12-month target price of $7.10. This is based on 1.34 times FY25 price to book, which represent about one standard deviation above its historical mean. We basically forecast that the current FY25 to FY27 net profit to progressively decline over our forecast period. But we think that the absolute earnings are still projected to remain at much higher levels compared to its pre-COVID years, given the strong air travel demand. In the medium term, we think that the stock will continue to trade at above mean price to book valuation in the near term, supported by its final dividends of 38 cents, which will go ex-dividend on the 1st of August of this year. So basically, we think that there's, for investors, we think that downside risks to our call include intensified competition, weak cargo operations, as well as a sharp rise in jet fuel price and a sudden jump in staff costs. But on the other hand, upside risks will include better than expected passenger or cargo use, a steep drop in jet fuel price, or less intense competition than anticipated.
Okay. Well, Eric, let me just ask a follow-up question here. So I think recently, maybe just about a week ago, Channel News Asia did a segment on the air logistics industry, and they invited C.H. Robinson's Southeast Asia head to talk about the outlook for air cargo, right? And I think the point of that program was that the air cargo prices are likely going to be firm, or if not higher, at least for the medium term. You do not think that this will actually have a bearing in terms of maybe boosting the cargo revenues for SQ in the medium term?
Yeah, we did notice that the cargo demand and load factor has strengthened somewhat recently, given the port congestion issue as well as the healthy e-commerce flows. But that said, we think that cargo use over the long term still remains under downward pressure, as industry belly hold capacity is likely to increase with the resumption of more passenger flights. So we understand that management is also closely monitoring its key trade lanes to ensure the competitiveness of its cargo service in the long term.
Okay, all right. Final question, Eric. The stock, according to your report, is yielding, I think, about high 5% dividend yields for the next year. Is the dividend payout likely going to be sustainable at these rates? And can you remind us when is the XD date for this round of dividend payouts?
Okay, the final dividends will be go X on the 1st of August. SIA does not have a official payout ratio, but over the last 2 years, they have been quite generous and they have been paying out at least 50% of its earnings. So going forward, we think that they will likely to do so. And hence, we are looking at about 34 cents for this new financial year FY25, which still translate to almost 5% yield.
Okay, all right. Thanks very much. So I suppose the end message to our audience is that maybe just hang on a while, get your dividends before taking the next step. Yeah.
Right.
Okay, great. Thanks, Eric. Well, we've come to the end of our show. And when we look at what's happened in the US, obviously the highlight this week will be Wednesday. I think the Republican Republican convention that will be held this Wednesday. So there is a fair bit of catalyst that will be coming up this week. So do watch out, be careful, and stay vigilant on your portfolio. So with that, thank you so much for spending your time with us this lunchtime, and we look forward to speaking to you again next Monday. Thank you.
Recording stopped.